We all know how essential our cars are in our day-to-day lives, whether we're shuttling the kids to school, tackling our daily work commutes, or embarking on exciting weekend adventures. Our cars become our trusted companions. But what happens when your beloved vehicle is on its last legs, or you're considering purchasing a car for the first time? It's natural to find yourself pondering the best approach to financing such a significant investment. In this video, we'll take a closer look at the three main options: buying, leasing, and financing. By the end, you'll have a clearer understanding of the pros and cons of each method, enabling you to make an informed decision. First, let's have a look at the main options for purchasing a car. Option 1. Buying a car outright. You know that feeling when you have complete ownership of something? Well, imagine that with a car. No more monthly payments or interest eating away at your hard-earned cash. When you buy a car outright, you're the captain of your automotive destiny, free from the monthly obligations. While it's true that buying a car outright requires a significant upfront investment, let's think about the long-term benefits. By avoiding monthly payments and interest charges, you'll actually save more in the long run. Just imagine no more worrying about budgeting for monthly installments or stressing over interest piling up. Plus, since you fully own the car, you have the flexibility to sell or trade it whenever you please, without any restrictions. Option 2. Finance. Hire purchase. Have you ever thought about financing a car? It's a popular choice for many people who want to own a car but don't have all the cash up front. With financing, you can put down a deposit, borrow the remaining amount with some interest, and then make monthly repayments. It's like a partnership with the lender, where you gradually pay off the loan while enjoying the benefits of car ownership. Financing allows you to break down the cost of the car into manageable monthly payments. By paying a deposit, you reduce the overall loan amount, which can make, the repayments more affordable. It's a great option if you need a reliable vehicle for your daily commute or other purposes. One of the best things about financing is that you have the opportunity to own the car at the end of the agreed period. It's like a long-term commitment that pays off. As you make those monthly repayments, you're gradually building equity in the vehicle, and once the loan is fully paid off, the car becomes yours to keep. It's a rewarding feeling to know that you've made consistent payments and now have full ownership of the car. Option 3. Lease. Leasing a car offers a convenient way to enjoy a vehicle without the monthly payments to the leasing company in exchange for the right to use the vehicle. These payments cover the depreciation of the car over the lease term along with any applicable fees and taxes. The advantage of leasing is that you're only responsible for repaying the depreciated value of the car rather than the full purchase price. With a lease, you have the flexibility to return the car at the end of the lease contract. This means you don't have to worry about selling the vehicle or dealing with its depreciation over time. Instead, you can simply hand the keys back to the leasing company and explore other options. By returning the car, you can easily transition to a new lease and enjoy the latest models and features. It's important to note that leasing comes with certain considerations. Most lease agreements have mileage restrictions, and exceeding the allotted mileage can result in additional charges. In addition, you're expected to maintain the car in good condition, as excessive wear and tear may incur extra fees, of course, comes in the way. However, leasing a car can be an attractive choice for those who prefer to have a new car every few years, enjoy lower monthly payments compared to financing, and avoid the responsibilities and risks associated with ownership. Don't forget to subscribe and hit the notification bell to stay updated with our latest content. Enjoying this video? Give it a thumbs up and share it with your loved ones. Now, let's jump right back in. Option 4. PCP. Personal Contract Purchase. Personal Contract Purchase, PCP, is a popular car financing option that provides flexibility and choice at the end of the agreement. With PCP, you set a fixed term, typically ranging from 2 to 4 years, and pay a deposit up front. The finance company then calculates the anticipated future value of the car at the end of the term, which is commonly referred to as the guaranteed minimum feature of the future value. Throughout the PCP agreement, you make monthly payments based on the difference between the car's initial value and its projected future value, plus interest and fees. Firstly, you can choose to keep the car by paying off the remaining GMFV as the final balloon payment. Secondly, you have the option to return the car to a finance company, assuming it meets the agreed upon condition and mileage limits, with no further obligation. Lastly, you can decide to part exchange the car for a new one, using any equity built up in the car's value as a deposit towards the next PCP agreement. PCP offers advantages such as a lower monthly payments compared to traditional financing and the flexibility to choose what to do at the end of the term. It allows you to enjoy a new car with the possibility of upgrading to a newer model every few years. However, it's crucial to consider the terms and conditions carefully, including any mileage restrictions and potential excess wear and tear charges. Furthermore, you should keep in mind that the final balloon payment to keep the car can be substantial, so it's important to budget and plan accordingly. That is to ensure that you can meet the financial obligations. Now let's consider the financial implications and costs. Let's first look into the financial implications and costs of the finance option for the Audi A3 priced at $33,900 with a 15% deposit and a 3-year term. 15% deposit, the initial payment for the Audi A3 would be $5,085. The interest rate on the loan would determine the additional cost over the term, assuming an interest rate of 5% per annum. For instance, the monthly payments would be calculated based on the remaining balance after the deposit. Let's say the loan term is 3 years. The interest would be divided evenly across the monthly payments. The total price paid for the 3 years would include the deposit, monthly payments, and interest charges. Leasing is an excellent choice if you want to drive a vehicle without a significant upfront financial commitment. It allows for more manageable monthly costs and enables you to afford a more luxurious vehicle than you might otherwise. However, keep in mind that leasing comes with mileage restrictions and potential charges for excessive wear and tear. If you enjoy long road trips, leasing may not be the ideal option. Buying a vehicle, on the other hand, is preferable. If you prefer complete control over your vehicle and finances, you won't have to worry about mileage restrictions or additional charges for wear and tear. While buying or financing a vehicle requires more research, it grants you full ownership and the flexibility to sell or trade it at any time, which leasing cannot offer. When you lease a car, you pay for the right to drive it for a fixed period, usually 3 to 4 years. Most leases are financed through the dealer. At the lease signing, you'll need to cover expenses such as taxes, title fees, and licensing fees, dealer documentation fees, and prep charges. There may also be additional costs like acquisition fees or drive-off fees, which can add up to thousands of dollars. Throughout the lease term, you'll make monthly payments to cover the vehicle's depreciation. Leasing offers several benefits, including lower monthly payments compared to buying, the possibility of driving off the lot without a down payment, and the availability of manufacturer warranties for the first 3 years of 36,000 miles. However, the drawbacks include mileage restrictions, additional charges for excessive wear and tear, the difficulty and cost of terminating a lease early, and the fact that you won't own the vehicle at the end of the lease. Buying a car means you own the vehicle instead of leasing it for a few years. While brand new cars can be expensive, there are more affordable options such as certified pre-owned vehicles or used cars. Monthly payments for buying a new car with a loan are typically higher than leasing. However, once the vehicle is paid off, it becomes officially yours. Buying a car offers benefits like no mileage limits, no wear and tear charges imposed by the dealer, and the ability to sell or trade in the vehicle at its current market value based on mileage and condition. However, drawbacks include higher monthly payments compared to leasing, the requirement of a larger down payment, and the responsibility for long-term maintenance costs once the warranty expires. Regardless of whether you choose to lease or buy, remember to consider your credit score. For leasing, aim for a credit score between 680 to 740, while for buying, a score of 660 or higher is preferable. The average lease payment varies depending on the credit card score range, with subprime borrowers paying around $612 and superprime borrowers paying around $571. The average monthly payment for used auto loans is approximately $527, while for new cars it is around $761. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.